Let's now look at a put option. This is also Apple, January 2023. So the same expiration date as before. Strike price of $100, and this is a put option. So this gives us the right, but not the obligation to sell a share of Apple for $100. Okay, and the option premium is $13.76. So this option, this privilege comes with a cost of $13.76 for each share of the underlying. And again, the contract is for 100 shares, so 100 times that. So now the calculation here changes completely from the call option, where the call option, we wanted Apple to become worth more and then exercise it to make money. So call options are when you think are valuable, when you think the price of the underlying will increase beyond the strike price. So it's a bullish bet, right? With the put options, it's the opposite, because we are agreeing to sell shares at a fixed price, strike price $100. So this will be beneficial if the stock price drops. So a put option is a bearish bet or a pessimistic bet that you think the price will decline, and that's when these options are worth a lot. Right? So a put option will give us a positive payoff if the stock is worth less than the strike price. So here in this case, less than $100 when we decide to exercise the option. All right, and the option is worth 13.76, as I mentioned, for each share of the underlying. So 1,376 for 100 shares. Okay, so let's also look at the payoff diagram. Once again, we have the strike price and the price of the underlying. So it's going to be the same thing. We're going to have on the x-axis the price of the underlying. That's what dictates the payoff from the option, as well as whether it's worth exercising it or not. But now, right, what's going to happen is if the underlying is worth more than the strike price, we're not going to exercise it. It's not worth, right? If the underlying is trading at 120, we don't want to sell Apple shares at 100. We could sell Apple shares in the market for a greater price, right? So we're going to have zero payoff if price is greater than the strike price. Now think about this a little bit. What about if the price is less than strike price? Each dollar it's less than the strike price, our payoff is a little greater. The ultimate maximum would be if it, like say, the company goes bankrupt, which it's not going to happen to Apple within at least by January 2023, almost certainly. But if it did, and if the price goes down to zero, that would be the maximum payoff if you own a put option, right? So this is what the decision criteria is, right? Positive payoff to put option if the underlying is worth less than the strike price. Zero payoff to call option if the underlying is worth more than strike price. So therefore, a summary of the payoff is maximum of, again, zero, but instead of S minus K, which was in the call option, with put option, it's the opposite, K minus S, right? So payoff, once again, cannot be negative. And we have greater payoff if K minus S is positive. And once again, the profit is going to be payoff minus the premium we have paid for it back when we bought the option, okay? So visually, this is what it's gonna look like, right? We have zero payoff if the underlying is worth more than strike, and then 1-to-1 greater payoff if the underlying is worth less than the strike price. And the maximum payoff we can get from this put option is the strike price, 100. So if the price goes down to zero, we can exercise it. We can buy those shares, say at zero from the market, or 0.01, whatever, if it's still trading, and then turn around, and then when we exercise the option, sell them for 100. Because it gives the option contract, gives us the right. So our counterparty is obliged to buy them at $100 from us. Right? Whomever created the option, wrote the option and sold it to us, is if we exercise it, they have to buy those underlying shares from us at the strike price. Okay, so that's what the diagram looks like. And the profit is going to be, once again, everything shifted downward just by the amount of the premium. So since the premium was $13.76, everything goes down $13.76. So if the Apple actually goes up, the price goes up and is trading at more than strike price, we are facing a loss, guaranteed loss of $13.76 at that point.